How a failed audit process led to fraud occurrence due to a lack of corporate governance.
In this video, we will talk about the role of the auditor and how an inefficient audit process led to a fraud being undetected, causing the Auditing scandal of 2000.
What is fraud? Fraud is an action and phenomenon that affects all areas of the business environment. Fraud is a type of criminal activity. Fraud is a deception and misinterpretation that would result in a party's unauthorized benefit, may it be financially or obtaining information. Fraud is not a mistake. Some examples of possible fraud are: 1. The misappropriation of assets. 2. Fraudulent financial reporting. The auditor makes an assessment of whether a fraud risk is present by utilizing what is known as the fraud triangle. This triangle consists of 3 factors. 1. Opportunity. 2. Incentives or pressures. 3. Attitudes or rationalization.
What is corporate governance? Corporate governance broadly refers to the mechanisms, processes, and relations by which corporations are controlled and directed. Corporate governance concerns the oversight of an institution's strategic and financial decisions, consisting of a system of practices that make up the structure of a firm's organization. Corporate governance must manage the interests of the firm's stakeholders. Also, corporate governance must create a strategy for achieving profitability. Corporate governance once focused on efficiently maximizing the wealth of shareholders. However, this now extends to the concerns and interests of all stakeholders and takes into account the happenings in the business environment. Corporate structure. Governance structures identify the distribution of rights and responsibilities among different participants in the corporation, such as the board of directors, managers. This also includes the rules and procedures for making decisions in corporate affairs. The role of an auditor. The role of the auditor is to express an opinion on financial reports. These opinions are in accordance with the ISA, or International Standards on Auditing, set by the External Reporting Board. The auditor works to assess how an entity operates and attempt to identify its operations and controls and possible cases of fraud. What is corporate governance in relation to auditing? Since the wide-scale recognition of corporate governance, over the past 15 years it has become the responsibility of auditors to provide assurance that fraud is not evident within a company. A few examples of how this is achieved is due diligence, an assessment of the risk of fraud occurrence, and the company's social impact. Of an auditor to provide assurance that the company's activities and accounting procedures will follow corporate governance guidelines and that the company's financial statements reflect the true nature of its financial position. The end goal of any audit is to ensure the absence of any misstatements and for an auditing firm to remain independent throughout the process in order to maintain its own integrity.
Auditing is an IT service company. This was built in 1995. Auditing is based in India. This is the third largest IT company in India. The founder and chairman of Auditing is Ramalingan Raju. he involved in a massive accounting fraud. This scandal makes a spotlight on corporate governance. Satyam was audited by PwC for 9 years prior. However, PwC was failed to file the fraud during that time. In late 2008, the investment bank Merrill Lynch detected the fraud in 10 days. They found that Satyam was manipulating US dollar $147 billion on financial statements. Lately, Raju wrote a letter to the Satyam board. In this letter, he admitted that he overstated Satyam profits, assets for several years. He also underreported the liability on balance sheet. At the end, Raju was charged with several events, including criminal conspiracy, breach of trust, forgery.
In this case study, Raju made an unethical decision to conceal the true business performance. The investors of Satyam were seriously influenced by their actions. Therefore, it is important to point out how corporate governance relates to these individuals. Corporate governance concerns the company's wide decisions that are made by high-ranking executives, and they affect the entire organization. A failure in corporate governance proves the ill intent of those leading the company. The most significant failure of the auditors PwC was in due diligence regarding the content of the balance sheet and income statements. Satyam would create fictitious cash flows whether it required more money to meet the predictions of analysts. These types of transactions between the company and customers should have been verified to ensure their legitimacy by PwC.
OECD released its Principle of Corporate Governance in 1999. It was argued that the guidelines only serve the purpose of protecting shareholders, but not all stakeholders. In the example of Satyam, it did not even serve the purpose of protecting shareholders.
When fraud pertaining to corporate governance goes undetected by auditors, it shows an ineffectiveness of an auditor to monitor the decisions and activities of executives through the relevant information they review. The auditors of Satyam failed in this case to gain a full view of the operations of the business and its cash flows. So, in the example of Satyam, it did not even serve the purpose of protecting shareholders. One of the most significant guidelines that failed to provide assurance included that the financial statements were correct and that there was no fraud evident. The most concerning thing about this is the accolades Satyam received regarding their use of corporate governance.